Good morning and welcome to another episode of Not Your Money. Last week we covered stablecoins, explaining how they work, how they compare to one another with our expert Christophe Lebrun. Today we have Christophe Lebrun again, and this time he's going to tell us about his CyberGold project, the first decentralized gold peg stablecoin. So without further ado, I'll bring Christophe on stage. Welcome, Christophe.
Hello, Francesco. Hello,
And
Marco.
Marco is here too to have the conversation with Christophe. So, Christophe, you introduced yourself last week. How about you do that once again here, just to remind any viewers who you are, where you come from, and then we'll dive into your project.
Okay, so I am a data scientist and I am working at HEG Geneva, Haute École de Gestion in Geneva. I am teaching Web3 and smart contract there, and I am also doing research mainly in the field of blockchain topics with several projects. I am also a lecturer in the CAS, Certificate of Advanced Studies, Blockchain and Finance. And I am also a board member of the Good Token Society, an association in Geneva, and I am the founder of CyberGold, the CyberGold Protocol.
Fantastic. So let's crack on then. What is CyberGold?
So CyberGold is the first decentralized gold-pegged stablecoin. So it's a protocol, and okay, maybe we can go in this more in depth with this definition. So what is a stablecoin? I guess that most of you are already aware of it, but it's a type of cryptocurrency that is designed to maintain a stable value relative to a specific asset, usually USD, so US dollar, or in our case, a commodity like gold. So it's a gold peg, so our reference asset is actually gold, but this CyberGold is a decentralized protocol, meaning that it's not a single private entity that is controlling the protocol, but it's truly decentralized.
Fantastic. Thanks for that. So tell us about the idea. Where did it come from?
Okay, so let's go back in the history. In early 2023, I was reflecting with a group of people about a DeFi protocol, and for this idea, we needed a stablecoin, in fact. But for ethos reason, we wanted to have a decentralized stablecoin. So the DAI, the biggest decentralized stablecoin, was a good candidate for that. But it was in March 2023, then the USDC depegged. And as a consequence of this depeg of the USDC, the DAI also depegged. So that was an unexpected behavior, because the DAI was supposed to be over collateralized in Ether, but for some reason, the DAI introduced the PSM, price stability module, to allow the swapping of some stablecoin, such as USDC, with the DAI. The purpose of that was to stabilize the DAI, but a consequence of that is that the DAI happened to be pegged to USDC instead of the US dollar. And so this was the origin of the reflection to have a truly decentralized stablecoin, because if you have a decentralized stablecoin that is pegged to a centralized stablecoin, is it still decentralized? So that's the question, and that was the starting point of the reflection about CyberGold.
So tell us more about what the problem you're really trying to address then.
Okay, so in fact, with CyberGold, we try to address two problems. First, we want to bring an alternative to gold-pegged stablecoin. At this time, 100% of them are centralized. So we are bringing a decentralized alternative for gold-pegged stablecoin. And the other problem that we are trying to solve is what we call the Stablecoin Trilemma. So we have an original technical design to try to solve that. So the stablecoin trilemma, it highlights the challenge of achieving three key properties, let's say, decentralization, scalability, and stability. So it's inspired by the blockchain trilemma, where stability replaces the security of the blockchain in the blockchain trilemma. And for now, the three main family of stablecoin are all making some
compromises,
trade-off, let's say, compromises, trade-off on one of these dimensions. So we are trying to solve this trilemma actually.
Interesting. Thank you. So it's you, Christophe. You have a team, and you've created an association to drive this effort. Is that right?
Yes, that's right. It's a non-profit association. It's based in Geneva, in Switzerland, and it was named formerly the Cifero Association, but we changed the name for consistency and clarity in its purpose. In our project is to build this CyberGold protocol. So it's aimed to be a common good monetary system. So we have a small team of 5 people actually, and all of them with a Web3 background and different competencies, technical competencies, marketing, legal, and so on.
Okay, and tell us a bit more then. Why is it a non-profit association?
Yes, that's a good question. It very often comes. In fact, it's for consistency with the purpose of the project. We aim to build a common good monetary system. So for us, that will be somehow opposite to be governed by a private company, private entity with private interest. So if we want to have something that is serving the common good, that is serving the public interest, it needs to be a non-profit structure and also a decentralized protocol. So this is the reason, but nevertheless, we also need some funds, some investors to make it happen, I would say. So even if we have a non-profit structure, we have a secondary token, a project token, the Lapis, that we will speak about later, that can make profit, let's say, if the project succeeds.
Okay, so let's start diving a little further into CyberGold. Tell us how does CyberGold differ from what is out there on the market right now?
So how is the market? 90% of the stablecoin market is USD pegged to the US dollar. So, and as you have noticed, we decided to go with a gold pegged stablecoin. Also, 90% of the stablecoin market is done by centralized actor. So if you had the market shares of USDT, Tether, and USDC by Circle, you reach almost 90% of the market shares already. So in our case, we decided to go with a decentralized design. And I would add that even within the field of the decentralized stablecoin, we have a particular design. So we are not using the CDP model that is used by the DAI or Liquidity USD, for example. So we are using a different model. So here on the screen, you can see different models of stablecoin, from the one backed by real world assets, such as gold, for example. In our case, we are decentralized. In the middle, you have the CDP-based stablecoin, which are decentralized but have a particular technical model. So, as you have seen in the trilemma, this design has some drawbacks. It also has some advantages, but it has some drawbacks. For example, the lack of scalability, or not so good capital efficiency, because you have to bring a lot of ether to create a new stablecoin. And also in this model, you have the same actors that are in fact asking for to borrow some stablecoin and creating the stablecoin at the same time. So the demand of stablecoin in the CDP model is led by the demand of lending, in fact, and not by the demand of stablecoin. So this makes this design not very scalable, and that could be one of the reasons why the decentralized stablecoin have such a small market share, in fact. And the last family, let's say, of stablecoin is algorithmic stablecoin, where their main drawbacks is the well-known deflationary spirals, as we have seen in the collapse of Terra Luna, because these stablecoins are not actually backed by extrinsic value. There is no real-world asset. There is no exogenous crypto assets backing the project, but it's only tokens from inner the project. So yeah.
Yeah. Sorry, just before we move on, another question, if I may, Christophe. So there's gold is certainly not a new fashion. Gold's been around for centuries, but there's certainly a return to gold. We've seen central banks stockpiling gold again, so there's certainly a demand for it, for its hedging properties. And you mentioned how the stablecoin market is dominated by centralized players and fiat-backed stablecoins in particular. In a market that so far has been vastly unregulated, right? So the market has been populated by whatever the sort of the demand and supply dynamics led us to. Why do you think we've not seen more of these types of ideas come to market?
Yeah, as I explained, there are different reasons. For example, the CDP-based stablecoin are not very scalable, so that could explain that. Also, the collapse of Terra Luna has put some high discredit on the algorithmic model, and I think it's a good thing for that. But also maybe as a contagion, it's brings some discredit to the idea of decentralized stablecoin. And for gold, I think, the things are slowly moving. You said that the central banks are now accumulating some gold. It started maybe 5 years ago. It's not that old, but I think that we will see this movement continue with the rise of the BRICS, for example, and this movement for de-dollarization. Maybe you will have a
Okay, so you've helped us differentiate where you stand versus what exists in the market. Tell us more about CyberGold's main features. How does it work?
Okay, so CyberGold is first pegged to gold, meaning that the price of CyberGold is going to track the price of gold. One CyberGold token, stablecoin, will be worth as much as 0.1 gram of gold. Also, it's not backed by physical gold, but it's backed by crypto assets, exogenous crypto assets, mainly Ether, in fact. and we will see how it works later in this discussion. Because of our particular design, which is not the same as a DAI, for example, we do not have CDP, but we have a very important property that is that the CyberGold and Ether are directly convertible at the level of the protocol, at the smart contract level. So you can swap CyberGold for Ether. Also, I think we will discuss more in detail the security feature, let's say, of the protocol. We have a multi-layered security because we are crypto backed. This brings some kind of specific risk, so we need to cover against this risk. So I think you have understood that the protocol is decentralized, so it's permissionless. Anyone can interact with the protocol. It's censorship resistant, non-custodial, and so on. Okay, and in middle term, so not at launch, but the idea will be to have an interoperable token, with the core of the protocol being on the Ethereum mainnet, but then the token will be usable on other chains using some interoperability protocols.
Understood. So tell us more about decentralization. Why does it really matter? Is that what we need? And yeah, tell us a bit more about that.
Yeah, I do think that decentralization is actually an important thing, even if centralization also has its pro. I am a strong advocate for diversity, and I think that decentralization brings a lot of advantages. So we need at least some kind of diversity between centralized and decentralized stablecoin. So what are the main advantages of a decentralization or decentralized stablecoin? First is the transparency. If you have a centralized stablecoin, usually you have opacity on the reserves of the protocol or of the stablecoin, there are some audits, but they are not done in real time, and you have to trust the auditors as well. While when you have a decentralized protocol such as CyberGold, you can see the reserve directly in a blockchain explorer, for example. Also, as I mentioned, it's permissionless, meaning that anyone can interact. A government cannot censor the protocol. A government cannot deny the right for holders to own their own token. So it's non-custodial. And for all these points, I think it's important to at least have some decentralized alternative to the centralized protocol.
Can I have Christophe, just one quick question? Like, what was for the user the difference between? Because I mean, the philosophy, it's all great and everything, but people do not invest in philosophy. So, like, real, actual difference from a buyer perspective, from an investor perspective.
Once more, I think it's a diversification of the risk. If you have all your eggs in the same baskets, you are going to expose yourself to a big risk. This was discussed during the previous episode last week, where you have an actor, Teaser, who was a market share of almost 70%, and because of that, this brings some systemic risks. So for user, I would say diversification of risk as well, mainly because it's a stable coin. So for now, sorry, it's a young protocol. So of course we need to create adoption and traction. in fact.
Okay, shall we get into more of the specifics? Mark, I'll be asking you to sort of help me on this side, but let's start with the peg. Why the choice of gold?
Yeah, because for the same ethos reason, I would say, for us, gold is a truly decentralized asset, while the US dollar is not a truly decentralized asset. The US dollar monetary policy is decided by the American Central Bank, the Fed, while it's not the case for gold. Several central banks are owning reserves of gold, for example, United States, but also China, Russia, France, Italy, and so on. So a lot of countries are owning big reserves of gold. So this makes a truly decentralized asset. So yeah, it's compatible with our ethos, but also gold is a reserve of value and hedge against inflation. And we can see during the last years, the quantitative easing monetary policy that that lead to print more and more dollars, more and more fiat money in general, but more and more dollars in particular. And I think that the movement of de-dollarization with the rise of the BRICS is going to put more and more pressure on the dollar. So we will see, I guess, the inflation continue in the upcoming years, and a placement and investment in the physical assets such as gold is a good edge against this inflation. So yeah, as I said, no political interference, universally recognized assets, and and a last point I would say it's a legal risk for issuers. A gold-pegged stablecoin is not going to be in competition with the upcoming CBDC, central bank digital currencies. So there was less risks for us as an issuer to issue a gold-pegged stablecoin instead of a stablecoin pegged to a national currency.
Okay, so tell us about the different players, the users, the roles required for the CyberGold ecosystem to run.
Okay, so there are three main roles, I would say, in the CyberGold ecosystem. The first role are the users, the stablecoin user, the people who are looking for stability, and so they are going to purchase some CyberGold stablecoin. But these actors are going also to pay fees to found the protocol, I would say. So they are mainly interacting through the CyberGold token. And they are looking for low volatility. The second kind of actors, which I call the hodlers, are the people that are going to help the protocol to bring it to life with initial funding, and also, as we will see in the solvency mechanisms, there are also a last resort bailout. So they are interacting through a secondary token, which is called the Lapis, for Lapis Philosophorum, because this is the token that allows the conversion from Ether to gold, or in the other way also. So this token has a medium volatility, and the last actors are the hedgers. The role of the hedgers is to endorse the volatility, in fact, of the exchange rate between gold and the reserve asset, Ether, in the name of stablecoin users. So stablecoin users are somehow looking for stability, and for that they are going to forgive some part of the profitability, while the hedgers on the other side are endorsing the risk, but for some profit, because they will have some leverage position of Ether, and also get some part of the fees generated by the protocol.
So if I understand correctly, Christophe, you need to start with the hodlers to get let's say the project up and running. You need that initial capital to create the ecosystem, right?
Yes, to finalize the development of the protocol, because it's not finished yet. It's still a work in progress, but also to ensure the cybersecurity through security audits, and also get some traction for the project. So with partnerships with centralized exchange, for example, this kind of stuff. So we need some initial funds. Yes, you're right. That's the starting point.
Thank you, Christophe. Let's try to look at each axis separately. So first of all, for the stability, how CyberGold track the price of gold, given that the inflow is Ethereum, the tracking is gold. So there are two different rates and two different volatile assets, right? So that they have completely different price dynamic. So how this is maintained across the ecosystem. So if I receive one CyberGold, and how this will look like.
Yeah, so the system track the prices through oracles, such as a Chainlink. An oracle is a component in the blockchain ecosystem that is going to bring some information from the real world, from the physical world, let's say, or external off-chain world, to the blockchain. So our protocol can be aware, even if decentralized, our protocol can be aware of the prices. For now, there does not exist some prices directly for the price of gold compared to Ether. So we have to combine two different price fees, one for gold in USD and one for Ether in USD. And by combining these two price fees, we get the price of gold compared to Ether. So this is the way that we are using for the protocol to be aware, if I can say, to know what is the gold price in terms of Ether.
And what if there is a discrepancy between the two data sources?
What do you mean by this?
So if you use those two data sources to actually derive the Ethereum price, what if there is a discrepancy? Like if this actually doesn't track as it should be?
Okay, so we will have some kind of low governance in the protocol. So if it happened that there is a failure in an oracle, the governance can decide to change the data source. So there will be a governance decision to change the data source. So we will have some safeguards, so to ensure that there is not a big manipulation, and the governance of the protocol can decide to change the origin of the price feed if it happened to be out of order, or to be manipulated or whatever.
Okay, let's move on on the other aspect, which is like how do you maintain the spec? So you have orders, right, that work as you explained, as basically bailout player or funds of last resort. So how they're incentivized, how their money flow works, and how their funds are actually used.
Okay, so before going into the bailout system, maybe we can just before speak about the how does the protocol maintain the peg. So as we have explained, we are using Oracle for the protocol to be aware of the price of gold and Ether. And then the next point is, how do we ensure that the price of our stablecoin, the CyberGold, is tracking the price of 0.1 gram of gold. So this price stability is ensured through arbitrage. So arbitrage, it could be used by regular users since it's a permissionless protocol, but it will mainly be done by some actors that we call arbitrageurs, that we expect to be mainly bots, in fact. So if so on the slide here, you can see the full convertibility property of the protocol. So anyone can bring some Ether, pay fees in form of lapis, 0.5% of fees, and then get CyberGold in exchange. And also, same, people can redeem some CyberGold, some stablecoin CyberGold, and get from the smart contract an equivalent value in Ether, paying some fees, 0.5% of fees. So what happens if the price goes out of the bonds? In fact, there will be some arbitrage opportunity. So if the price is above 1.05 times the pegs, then there will be an arbitrage opportunity, and some actors, so as I said, mainly some bots, will be able to bring back some to buy some CyberGold to increase the supply and to make the price go back inside the bounds. And same thing, if the price is below the peg, they will be able to buy CyberGold on the open market on CX or DX, and to swap them at the protocol level to reduce the supply in the circulating supply of CyberGold, and to bring back the price into this bound. So the stabilization mechanism is mainly arbitrage. And
Isn't
since
it a bit
permissionless,
isn't there an issue here on the low side? Because on the upper side, to a certain extent, makes sense. I will retrieve Ethereum, but I mean, I will expose myself to Ethereum, so I don't necessarily have an issue. But when it actually goes down and I have to rely on the burn effect, what if I just say, well, I don't want to take the risk of arbitrage back because I will be buying a token who is potentially the pegging right now. Actually, it is the pegging at the moment. And I have to rely that if I'm doing that, my arbitrage will actually works. It's not like I know for sure it works. It's like, okay, that the price will be repegging because everybody is believing on me arbitraging me back to the even price.
So yes, if the price is below the bound, the arbitrageurs will be able to burn some tokens. So they will have some CyberGold. You bring some CyberGold to the protocol and you get Ether. And because of that, you can buy CyberGold on the open market at a lower price. For example, 0.9 if we get below the price, and get Ether for the value of 1, in fact. So you are going to make some profit directly at this step.
Can I ask a question regarding the actual reserves? Is that what does that go back to the Lapis initial investment? So is there a minimum hurdle rate, Christophe, for the
You mean for the fees? Just to be sure I understand your question.
What I'm trying to ask is there a minimum level of initial investment required to create that reserve ecosystem?
Yeah, so for the Lapis, there will be a maximum supply of 21 million. Okay, and so you will need some of this Lapis to make the arbitrage. And then the fees that are paid at minting time or burning time will be redistributed and splitted between hedgers and the hodlers that are staking their Lapis tokens. So I'm not sure if I answered to your question exactly, but yeah, that's the idea.
Let's move to the global reserve, because I think that's also what the risks are highlighted. It's just to understand what's the global solvency of the whole protocol, and how those reserves are always more than the eventual claim, or can always satisfy a claim.
Yeah. So actually, the long-term resilience and the solvency of a decentralized protocol is always the main challenge, because you have two different price dynamics between the reference assets, gold in our case, and the backing asset, Ether in our case. So you're true that the different dynamic pose challenges to decentralized design. So this is the main, the hardest point. It's not stability, short-term stability, as we have seen. It's done pretty easily through full convertibility. But for to ensure solvency, so we have a two-layered protection, securitization of solvency. The first layer, which I call delta neutral hedging, is the fact that some hedgers are bringing some additional reserve, are topping up the reserve of Ether. So as I explained, they are going to take the exchange risk, in exchange of some incentives, such as fees, which can be seen as a insurance premium. And also they have a leverage position for Ether. So what happens if the price of gold compared to Ether move? In fact, there will be a rebalancing, automatically rebalancing at the level of the smart contract between the backing pool and the hedging pool. So if the price of gold improve, the backing pool will scale in the same proportion, but the hedging pool will reduce. And because of that, there will be a leveraged effect. That's how it works. So this is very different from the CDP model. In the CDP model, you have the same actors that are creating the stablecoin, which are minting the stablecoin, and which are bringing the over collateralization through the collateral deposition. In our case, we have two different actors, stablecoin users and the hedgers. So the hedgers are bringing additional reserves. So this is
Can I ask you is this like a liquidity pool is going to be managed directly by you, like a private smart contract? How's this actually will be implemented?
The idea is that this pool, this protocol reserve, both the backing pool and the hedging pool, will mainly be stacked in liquid stacking protocol, such as Lido, for example, to get a yield, and this yield will be used to incentivize the hedgers, in fact. So we will have a leverage position not only on the Ether variation, but also on the stacking rewards in the liquid stacking protocol. And yeah, this is the idea at starting, but maybe it will evolve at some point later in the future if the governance of the protocol want to diversify the usage of the reserves, for example.
And how do you manage, for example, what's going to be the time for the actual workflow for an eventual claim and withdrawal? Because if you have the backing and the hedging pool that are invested into Lido, for example, then there are some mechanism in Lido that allows you to withdraw, which incurs in time-sensitive activities, meaning it's not instantaneous, and it will take a bit of time to do all of that. So are you taking into consideration this when you are allowing people to withdraw, and you are communicating this to your investors that a withdrawal claim has to spark as a chain of events behind the scene that will result in the withdrawal being available?
Okay, so currently the idea is that the protocol will get some kind of fractional reserves of Ether, about 10 to 15%. So to ensure the operation, short-term operation, if you want to withdraw. But if there are big withdrawal, maybe this fractional reserve will not be enough, and in this case we will redeem the stacked tokens instead. We think that's not a big deal, because in fact it's mainly the arbitrageurs that will interfere with the protocol in this way. So it's not regular user. Regular user are mainly going to use stablecoin for stability and just use the transfer function in the protocol. But for more advanced users, such as arbitrageurs, they could do that. So the idea is that if we stack the reserves of the protocol, it will not be 100%, but we will have a fractional reserve by 10%, about 10% of the reserves, to ensure, as I said, everyday operation. But if it's not enough, we can redeem some stacked token, such as ST-ETH for Lido protocol, for example.
So your base currency is effectively, so you don't have direct exposure to gold per se. You have it synthetically, if you like, via ETH. So what if ETH goes down? I know that's quite an Armageddon scenario, but I mean, what happens then?
Yeah, so if ETH goes down, I would say in every day, because it moves every day. So some days go up, some days goes down, and then the primary mechanisms that I have just explained is going to be triggered and to ensure the solvency of the mechanism. But you're right, if it happens that there is a big crisis and that the price of Ether lose, for example, 60% in a short period, it might not be enough, because we are going to target about 100% of over collateralization. So the hedging pool should be about as much as the backing pool that is the target that will be reached through incentivization. By the way, if it happened that the hedging reserves become depleted because there was a big drop in the value of Ether, then we have a second layer of protection, and the stacked lapis can be used to for for this second layer. So, for example, if the protocol is only at this point backed by 90% of Ether, and we have a lack of under collateralization of 10%. So we are going to give back some of Ether, for example, 85%, and the remaining, for example, 15% will be in form of Lapis token, so the secondary token. So
thank you. Yeah, thanks for that. Cool. Yeah, so we thought we'd dig into stress testing. Can you tell us where you are in your journey, Christophe? Have you started? I mean, we've spoken about some scenarios, solvency, ETH going down. What are your plans regards to stress testing? For instance, if the market can't promptly intervene to rebalance the pool?
Yeah, so on our roadmap, so we have done the most of the design of the protocol, and so it's currently in development. Once we have developed the MVP, the minimum viable product, then we are going to release it on some test nets, just to run a lot of tests, actually, both for cybersecurity, but also economic resilience of the protocol. So these crash tests have not been done in true live condition yet, but this is on our roadmap. So the protocol is not finished yet. So we are still in the development of the protocol. So you also had a question: what if the market does not promptly intervene to rebalance the pool? So just to be sure, what do you mean by rebalancing the pool? Do you mean the top up of the hedging pool, or the rebalancing between the backing pool and the hedging pool? So if it's the balancing between hedging pool and backing pool, like on the slide about layer 1, then this is done automatically at the smart contract level. So it's just, in fact, a variable that is changing for the ratio between hedging pool and backing pool. So this is done automatically. But what happened is that the hedging pool can be considered as insufficient. As I said, we have a target of about 1% of over collateralization. So our objective is to have an hedging pool at least equal to the backing pool. If it's not the case, then we will have some incentives. The share of the fees will be higher for the hedgers than for the Lapis hodlers. So yeah, we have some incentives, and we expect that with the yield of the stacking rewards and the leverage on that, will promptly replenish the hedging pool. If that is not the case, then we have the secondary mechanism.
Thank you, Christophe. Marco, anything else you'd like to probe on the project? Any of the workings, mechanics, technical aspects?
No, like especially for the stress test, maybe like have you engaged with somebody like an external auditor or some entities that are proof testing or your algorithms and your mechanisms?
Oh yeah, we do not have done it yet, as I said, but the idea is to get funds to be able to ensure the cybersecurity of the protocol, not only test for the code, but also for the economic dynamics. So yeah, there are a lot of tests to do.
Maybe then, Christophe, to finish off on the project, do you want to maybe help us and the viewers understand where you're at? What are the sort of key priorities, next steps before we draw to close?
Yeah, so our next step is to raise funds. In fact, to move faster and further in the development of the project. The MVP is pretty close to be done, but to ensure the cybersecurity, as I said, but also the legal compliance of the project and the economic stressing test. We need some funds, but to get these funds, there are a few steps to do. So, for example, I had written a white paper, but this was 1 year ago, so it's kind of obsolete on some aspects, and not it was not aimed to be presented to investors. So I have to work on all this documentation, executive summary, business plan, white papers, and in the same time we are continuing to develop the protocol.
How many people are in the team right now, Christophe?
Yeah, 5 people are currently in the team. Yeah,
and that includes developers. So you mentioned the MVPs.
Yeah, we have in terms of technical people. I am designing the protocol, but we have a smart contract developer and also a front-end developer, Web3 front-end developer.
Okay, and where can people find out more about CyberGold then?
So currently we are mainly on LinkedIn. So you can find us on LinkedIn. There is a page for CyberGold. You can reach me also directly. And we have a website, even if it will need some refreshment at cybergold.io.
Fantastic. Well, Christophe, thank you very much for sharing your ideas, your project, your view on the stablecoin market, and how CyberGold certainly seems to be looking for a niche, for a slice of the market that is vastly underrepresented. So we wish you the best of luck in your endeavors, and that you can bring this to market. Perhaps we can check in with you in, well, you didn't mention timelines really, but when do you expect this? When do you expect to be live?
The deployment on testnet is expected to arrive in the first trimester of 25. And so we expect at least 6 months of test before going live to mainnet. And then, yeah, it will be a first version, but then we have some interesting features on the roadmap. So, for example, I spoke about interoperability with other chains, so that will appear later.
Fantastic. Christophe, once again, thank you. Best of luck. And we'll check back in to monitor progress. All the very best.
Thank you very much. Thank you, Christophe.
Thank you, Marco.
I hope you enjoyed our video. If you found the video informative, please don't forget to follow our channel and click the alarm button to be informed of new videos coming through. There is plenty to learn and get your head around on your journey to mastering crypto. Thanks for watching, and see you on our next video.